The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
That AI sell-off looking a lot more like an AI rotation, and we're going to tell you why. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Isabel Lee. And Romaine, it continues to be such a headline-driven market. We're looking at an S&P that just flipped to the negative territory a few minutes ago, around 7 minutes. Earlier in the day, it climbed back to the green at around 115, but now we're back in the red. We got news that crossing the wires that Iran says it won't back down in talks, and you're also seeing Brent crude lower by around 0.5% to $104 per barrel. Bond market is still where the interesting moves is. You're seeing more muted moves in the longer end of the yield curve. More action is in the 2-year yield, up by around 4%. And the 10-year yield still hovering around a 1-year high, Romaine.
Absolutely. Here, back to equities, though. Of course, you see the main indices in the red, including the Philadelphia Semiconductor Index and most of the tech stocks. But there is an AI rally going on. It's just not here in the U.S. It's over there in Asia. And that was actually sparked by Nvidia's evolving focus beyond the U.S.-led data center build-out and into this so-called physical AI space like robotics and consumer devices, an area now being led by companies in Korea, China, and Taiwan. In fact, South Korea's benchmark Kospi, which is already on a record run, surging 8% in the most recent session, and that was led by a 30% jump alone in LG Electronics. Jensen Huang really giving investors a clear roadmap last night for what he sees as the next chapter of the AI build-out. And apparently some U.S. investors had already sniffed this out. The prime trading desk over at Goldman Sachs, they said semiconductor stocks have been the most net sold U.S. subsector over the past month by hedge funds. But it also said those same hedge funds maintain their overall exposure to AI by rotating into non-U.S. chip makers, with Asia being the most net bought region in May. So that's where the tech investment money is flowing for now. But of course, it could rotate again soon with the addition to U.S. public markets of OpenAI, Anthropic, and SpaceX. SpaceX, the first to put its cards on the table, filing its S-1 disclosure yesterday that showed a sprawling, still money-losing enterprise with a massive CapEx spend and sky-high valuation ambitions tied to literally astronomical goals like putting 1 million people on Mars. Back here on Earth, Ross Gerber joins us here to kick us off to the close, co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, a lot to unpack as to what transpired over the last 24 hours here. Of course, we got some details on OpenAI's fundamentals, on Anthropic's fundamentals. We got the Nvidia report, and of course, we got that long-awaited S-1 disclosure from SpaceX. What, if anything, is most important to you right now?
Well, you just threw out like everything that's important to me, right? And all in one thought. So yes, there's this convergence of sort of AI and space that, you know, is sort of led by SpaceX, but followed by Nvidia and many of the other companies making hardware for the AI scalers. And so it's a really exciting time for technology when you think about the convergence of space and AI and data and connectivity. And S1 for, you know, SpaceX was one of the more interesting documents that I've read for a company in my lifetime. So I think it's a very aspirational company. And on the other side of the coin, you have Nvidia, which is really just in the sweet spot of just profiting off the massive investment coming from all over into building, you know, AI systems and data centers. So It's a really unique time in technology history, and it almost feels very different than .com in that all these companies are so legitimate, where in .com, a lot of it was just, you know, BS.
Yeah. Well, I am curious. I do want to zero in on Nvidia, because the thing that really jumped out at me was when they talked about how they're breaking out as a line item both the data center revenue, but also this edge computing revenue, which, let's face it, right now, a tiny part of their business, less than 10% of revenue. But he was very clear on that conference call, as was Colette Kress, about how the idea that this is where the puck is moving, and that, at least in their view, Nvidia was still going to be the center of that, the way it has been at the center of the LLM data center build-out.
And I think that was important to them to show that they're evolving as a business and not just sort of sitting on their laurels, raking it in on their chips, and sort of like waiting for people to take their business. In fact, they're moving very rapidly to compete in the CPU space, which has been sort of this hot discussion, like Intel's all of a sudden going to be good at something again. And actually, Nvidia is really looking to compete directly with all of its competitors. And so I actually think the competitors should be more scared of Nvidia than Nvidia needs to be scared of them, because they're very good at what they do. But I also thought it was very interesting the way they broke out the data center revenue now from hyperscalers to other AI builders like Sovereign, robotics and such, because what he's saying is we've made a lot of money off the Microsofts and such, but we're going to make a lot more money in the future as many different enterprises and governments want to build their own AI that aren't open systems like, ChatGPT.
Ross, moving to SpaceX, what do you think is the biggest hidden risk when it comes to their scale? Is it regulatory bottlenecks? Is it the intensity of the capital? Or do you think it's just really the scaling of Starship, which a lot of the valuation really hinge upon?
Yeah, I mean, there's no doubt that the ambitious goals that they have are a risk. I mean, but you can't really look at a company like this and try to quantify risks that are just massive, because they're just massive. And so yeah, it's a huge risk that they aren't successful at anything that they do. But there's also, if they succeed at these things, they're massive rewards. And I think that's sort of the way you have to look at it. But one risk that I am most concerned about, which is a risk that many people don't talk about enough, which is what I call Elon Musk risk. If something happens to Elon Musk, it really changes the way that these enterprises will be valued and looked at, and what their potential is to complete their missions. So, I think there's a lot of succession risk in the business too.
What do you make of the government structure? I mean, Class A carries 1 vote, Class B carries 10 votes, and Elon Musk, I think in total, combined, I think he commands 85% of the voting rights. Right. We have one quote saying it's basically his company.
Right. So Elon learned, when he took Tesla public, he was like, every shareholder will get 1 vote, and he ended up owning, let's say, 15%. And he really hated when activist shareholders like myself really try to hold him accountable to his actions. And he hates it. He doesn't want to be accountable to anybody. So with this new structure, he's not even going to pretend that he's some sort of fair dealer. And in the S1, the first page is basically if you invest in this, this is Elon's company. You will have no control. The board is all his friends. And in Texas, it's called a controlled company. Texas actually requires independent directors for everything. But if you own, I guess, over 51%, you can call it a controlled company, and then put all your own directors and completely control the company. So if you're investing in SpaceX, you are 100% at the whims of Elon, and nothing you say or do is going to matter. And I think investors should take note of that, but at least they've disclosed that and made that very clear.
Absolutely here. I mean, this is the ultimate key man risk. A final question, and this really just has to do with the number of options on the table when it comes to trying to invest in our future, whether it's going to be data centers in space or, a world model of LLMs here on the ground. The options are clearly starting to open up, at least in the public markets, that I should say, just to be clear here. Is this a pick and choose, Ross, or is this you can buy a basket of these types of names and ride the wave?
Well, I'm a big believer in the basket philosophy here, because let's say you take those 4 companies, the big 4, SpaceX and OpenAI and Anthropic, and I don't know, you can pick Databricks or one of the other big ones, and if you invest in a basket of these, I think you're best off, because A, they're all coming out at ridiculous valuations, and B, all their businesses are evolving rapidly, so we're not really sure what these things will look like. And it just doesn't seem like you'd want to concentrate a lot of risk at such high valuations. And so I think investors are actually better suited doing what we call dollar cost averaging, which is don't buy these things right when they go public. If you have $100, split it up into $10 increments and maybe buy it once a month for the next 10 months, it just makes sense, to spread out your investment over the first year, as there's so much volatility and liquidity, and we've got higher rates and inflation too. So I think for investors, you want to take a slow approach and accumulate these stakes with a long-term perspective. But on the short term, I think we're going to see volatility, and I think it's going to be difficult to want to place an all-in bet on something.
Ross, always appreciate it. Ross Gerber over at Gerber Kawasaki. We're counting you down to the close with a big focus on tech. We'll be back in a moment. This is Bloomberg. All right, well, the largest IPO in history is about to taxi out onto the runway. And our next guest, he actually built his banking career by advising clients and then valuing some of the highest profile IPOs out there. He then made his way into venture capital with stakes in, well, some of these years' largest IPO names, including Spacex. And he joins us right now, Paul Abrahimzadeh from 1789 Capital. And Paul, before we talk about your current role, I do want to talk about your past, particularly over at Citi, leading the syndication desk there. You were the guy that when the investment bankers got done with these IPOs, they handed them off to you to find a way to execute and price this stuff into the market. We're talking about potentially $75 billion raised, almost close to a $2 trillion valuation that this street is going to have to absorb. Are we ready for this?
Thanks, Romain. Great to see you again, and great to be back on Bloomberg TV. We do think the market's ready for it. I think it's incredibly well-timed. Ultimately, this is a platform play. SpaceX is a pillar business across three important divisions, all of which have very strong growth, as people can see in the S1 that's been filed, very strong historical trends, and obviously the company's poised for growth on a go-forward basis. So it's a must-own name. The KPIs speak for themselves. There has never before been a company going public at a $2 trillion market cap. There's never before been a $75 billion IPO. It's 3x the second biggest IPO in history, which also was a technology IPO in Alibaba. And there's never been a company with these kind of KPIs. When you look at the historical last 12 months, the revenue scale, the 30% plus growth, the EBITDA margin, again, you get back to this concept of being a must-own name. The big factor is obviously the size, and the reality is the market has been positioning for this IPO as well as the two other large IPOs expected this year. So there's been pre-positioning in the market. People have been making room in their portfolios, adjusting their exposures to have sufficient dry powder to invest in IPOs like SpaceX.
Yeah.
If you think about the prior jumbo IPOs, the biggest end of the spectrum you would see from an order flow standpoint historically was $250 to as much as $500 million. In the case of these large upcoming IPOs, you're going to see order sizes from the bigger mutual funds, pensions, and sovereigns eclipsing $1 billion, in some cases up to maybe $3 or $5 billion. So we do think there's sufficient dry powder. We think the bankers are doing a great job in the way they're positioning the business, and ultimately will do a fantastic job with global syndication.
At what point, Paul, does SpaceX stop being compared to its aerospace peers and maybe being compared now to critical infrastructure? And what does that do to valuation and maybe oversight?
Well, again, I bring it back to the first point, which is this is a platform play. So when you think about the space component of this business, over 80% share with regard to the global mass to orbit industry. That's massive. The TAM is also gigantic. The space and connectivity TAM alone, as disclosed in the S1, is $2 trillion. And this is an overall business, an enterprise with north of 30% EBITDA margin. So at this close to $20 billion revenue scale on a 12-month basis, on a trailing basis, with that type of EBITDA margin, levered to industries like space and telecommunications with Starlink, it absolutely is a fit from an infrastructure standpoint.
I am curious about this idea, and I mean, we should just be clear. I mean, this is kind of one of these must-own stocks, where no matter how you feel about the fundamentals, no matter how you feel about the governance. But I do want to ask you about the broader ecosystem in space, AI, et cetera, and whether this actually sort of unlocks that a little bit more once we actually get this IPO out there, or is it going to have the opposite effect, where it's just going to draw a lot of oxygen out of the room, given its size?
It's certainly a possibility. Again, there's never been 3 IPOs of this scale to go public in a single year, let alone in a multi-year period. So we're in unprecedented territory. I think what you're seeing is the private market is showing that there are some constraints in terms of the ability to fund high-growth companies at this scale. Obviously, the recent private round by OpenAI is the biggest ever done in the private market by a magnitude of 10 relative to the Ant Financial private placement that was done about a decade ago. The questions as it relates to the business and AI, we invested across 8 tranches of SpaceX, XAI, and X from our fund at 1789. XAI had material cash burn. The beauty of this combination with SpaceX as well as X is you've got cash flow coming out of the overall enterprise that can fund the growth in AI. So specifically, when you look at CapEx from the overall company, north of 60% of that historically is being spent to now grow XAI. And that's going to be a gigantic growth lever for the business. It's where the market's heading. It's been a multi-billion-dollar revenue business, but with dramatic upside. And the TAM in AI, what's interesting, it's 10x larger than what you're seeing from both space and the communications segment or connectivity segment combined. That's an incredible TAM, and the company's gonna be going after that. Competitive, obviously, with OpenAI and Anthropic and others, but we believe in xAI's ability to capture share.
Paul, always appreciate it. Paul Abrahimzadeh, partner over at 1789 Capital and a stakeholder in SpaceX. As we continue to focus in on that, our next guest actually says, don't just think of it as a space company, think of it as an IPO company. Chad Anderson, an early investor and frequent investor in SpaceX. He's going to be joining us in just a second, the founder and CEO of Space Capital, right here on The Close, right here on Bloomberg. Sticking with SpaceX, those IPO figures, they were big, and the company is getting ready to launch its Starship rocket in what could offer a bit of proof of life on those betting on the space race. Joining us right now to talk a little bit more about the SpaceX IPO, and more importantly, what the future of this company is Chad Anderson. He was an early and a frequent investor in SpaceX as a private company. He's the founder and CEO of Space Capital, which is a portfolio of dozens of companies involved in, I guess, this new space race, for lack of a better phrase. And that is where I want to start. Is this a space company?
Yeah, I mean, so we've been making the case for a long time, over a decade now, that the space economy is a lot more than just rockets and satellites, right? Now we have a definitive proof point. So SpaceX is one of the key takeaways for the S1 for me is that SpaceX is definitively an AI company, right? Like, they are not a space company in the traditional sense anymore. If you look at the big numbers that they're putting out, right, a $29 trillion TAM, largest addressable TAM in human history, 90% of that is AI. So, and they're putting that out there because that's their North Star. Like, that's the market that they're going after. And they're building out the infrastructure to enable them to capitalize on that.
I am curious, and you're going to hear the criticism. When people see that total addressable market, there are a lot of people say, okay, that's just BS. That's just something made up. Where is that market coming from? I mean, in terms of the use, in terms of the end user, in terms of the customers, and I know we're talking long term, but where is that?
Yeah, so the IPO is the headline, but this opportunity is much broader. So we are in the early innings of a multi-decade infrastructure cycle. There is hundreds of billions of dollars of infrastructure, legacy systems that are on orbit today that are being replaced. And we're building out an entirely new layer, right? So SpaceX is at the center of this, and they own the rails. So they are in a very advantageous position to take advantage of the fact that space and ground are converging on a macro scale. So you look at where the revenue is coming from and where the real business growth is coming from. They got Starlink, which is internet broadband. You got direct to cell going after the telco market, which is much bigger. And now you've got orbital data centers that are going to be doing inference as well. So you put all of those things together. I mean, that is a lot of infrastructure. And that's what I think allocators are betting on here, is that SpaceX is going to be the company that owns access to infrastructure for, that's going to be powering the global economy for the next 50 years.
When it comes to valuation, you said that this shouldn't be modeled with traditional DCF, but rather over 50 years of framework of infrastructure. Some critics might say that that just means fundamentals don't matter. What would your response be? So
we are, another headline is the net loss, right? And if you think about the fact that Starlink they have 30% growth in revenue, nearly $19 billion. A lot of the hole to fill is because of their big CapEx spend, right? So they're investing heavy CapEx into AI and into Starship. When those things come online, they're going to power a ton of growth for this company. So when you're thinking about the revenue today is coming from Starlink broadband. We're not even, the direct-to-cell satellites haven't even printed any revenue. Orbital data centers haven't printed any revenue. They've got billions of dollars in contracts with NASA to build a moon base and to support that, right? And there's all these other frontier markets as well that are in line of sight for this company. So it's really hard to look at this company and say, I'm going to look at a growth rate in perpetuity and like assign a terminal value here and do a regression analysis. This is not something that you value with a DCF model. This is something that you value with options.
So you mentioned Starship. We know it's generating billions of dollars, but why are we absorbing heavy losses into AI and Starship? Is the message here that profitability is less important now than speed, perhaps?
Well, so I think they've filled the gap on the AI side, right, with this Anthropic deal. So they're bringing in $1.25 billion a month, $40 billion through 2029. So yeah, I think that they've filled the hole on the AI side. Starship is a vehicle that they've been investing heavily into. There's been $15 billion invested into this program. We'll see what happens tonight, but they're expecting it to come online and to reach operational cadence by next year. So today and later today is going to be very exciting to watch this test flight and see how it goes. But Starship is critical to the future of this business. It's what enables all those businesses that we've talked about. The base case model is dependent on Starship, so it needs to work.
I am curious about some of the other companies you're invested in. Obviously, SpaceX is the largest by default, but when we talk about Rocket Lab and Vert and some of these other names here, is this all just sort of part of a SpaceX flywheel, or are these sort of individual stories on their own?
Yeah, so SpaceX is the apex player, hands down, right? I mean, the only reason that we're talking about this as an investable category is because of the work that they've done to provide access to orbit at affordable and transparent prices. So that's what's enabled new entrants to come in and try out, innovate and try new business models and raise capital to do that. We're seeing innovation across, just to give you a sense of the scale of what we're talking about here. So GPS, 24 satellites, have generated trillions of dollars in economic value. We now have 18,000 satellites in orbit. 10,000 of those are SpaceX, 8,000 of those are others. We're going to be launching 2 million satellites between now and 2040. We are at an inflection point. There is an incredible amount of growth here. SpaceX is clearly the apex player, but there are a number of other companies doing really incredible things.
All right. Are you going to be, where's the actual IPO going? Because it's not going to be at the NASDAQ site. Is he going to do this down like at Starbase or somewhere?
So I don't have those details, but it wouldn't surprise me. I mean, when Firefly went public, they did it, and they timed it with the bell ringing with a rocket test.
Well, there's been a lot of rumors saying that he's planning something big and that it's not necessarily going to be in Manhattan.
I'm sure it will be.
So anyway, all right. Well, it looks like that roadshow is going to have to get going soon, and of course, Bloomberg reporting saying that we could get a pricing as soon as June 11th. Chad Anderson, founder and CEO of Space Capital, and an early investor in SpaceX. When we come back, we're going to continue to talk about what's been going on with regards to SpaceX. Surprise. But more importantly, talk a little bit more about how you actually value these types of moonshot companies. We're going to talk to economist Harvey, director of research over at Research Affiliates and a professor over at the Duke Fuqua School of Business. That's coming up next year on The Close, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Isabel Lee.
We take a look at a market. They're not getting a whole lot of juice today because of Nvidia being down. There was a lot of expectations, of course, that their earnings would help to lift the market. They were decent earnings here, a beat and a raise, but not necessarily enough for a stock that had been on a phenomenal run. But all the focus right now is on kind of the next big thing out there. Obviously, SpaceX is a big part of that. But a lot of questions as to how you value the next big thing when you don't really know where we're going. I mean, we were just talking with Chad. I mean, was it $30 trillion addressable market? Is that true? I don't know.
And he said it's basically an AI company. So at what point do we stop comparing it to its traditional aerospace companies? And SpaceX, if you look at it, it's like three rolled into one. It's like there's Starlink, there's defense, there's long-term infra. So where do you put it and how do you value it? It's so interesting.
All right. Well, economist Harvey, he's been evaluating companies, evaluating markets, and trying to find better ways to actually address them. He had a paper out a couple of months ago, kind of talking about redefining fundamental growth to align more with actual value creation. We want to bring him into the conversation now, and maybe if we can apply it a little bit to SpaceX. Harvey joins us here, of course, over at Research Affiliates, also professor over at the Duke Fuqua School of Business. And Cam, I do want to start with kind of this idea of kind of a moonshot company with these lofty goals, lofty numbers that are impossible to prove and impossible to disprove, and how you even put any sort of fundamental valuation on it in an accurate way.
Yeah, so you need to be very, very careful. And what's important is obviously the growth prospects, but many of these companies are valued like a lottery, that there is this small probability of an explosive upside, and you're willing to pay for that. So and it's a bit paradoxical that the expected return might be low, but there is this small probability of the explosive payoff. again, it's like a lottery. If you buy all the lottery tickets, then the expected return is negative.
Well, that's
so for these particular companies, they're difficult to deal with, but really what you're buying is the probability of a giant payoff.
Well, that's
and people willing to pay for that.
Well, that's what I'm curious about, because when I was reading the paper, I mean, you touch upon kind of the tried and true fundamentals, profit growth, sales growth, R&D spending, things like that. But we've seen this before, and this isn't just a SpaceX issue. We've seen this with other companies, particularly in the AI race, and even prior to that. The idea that there is some true growth down the road that will make today's a crazy multiple actually look a little bit more reasonable. Is there any way that we can get to a point where that can, I don't know, somehow be factored into today's price? Or is that just, like you said, just the option, the lottery ticket, if you will, the hope?
Yeah, the option is real. So there is a chance of, the $30 trillion company. So people look at that, even though it's a low probability, they're willing to pay. And that's why we see the expected valuation of SpaceX is going to be gigantic. It will be in terms of like a price earnings ratio, more like way beyond Nvidia.
Wow.
And again, this is being bid up because people believe that there is a probability of this lottery-like payoff. So this is an extreme case, but the logic applies across the board in the growth investment sort of style. And that's what my paper does. It looks like growth. It takes another look at growth investing and applies some fundamental tools to kind of reevaluate how we think of a growth investment strategy. So this is a diversified portfolio of growth rather than taking a bet on a single name like SpaceX.
So Cam, do you think that the growth versus value trade is going to be extinct in a market that's really just dominated by AI and intangibles?
Yeah, so the two main investing styles are value and growth. And ideally, if you're in a value regime, you're invested in value stocks. And when we switch to a growth regime, you're in growth stocks. And then maybe if it's not so clear, you're 50-50. And one thing that we point out in our paper, and this was a surprise to me, that the 50-50 weight of value and growth for all major kind of indices for value and growth just equals the market portfolio. So think of the overall market. So what that means, and this is important, that if a stock is not in the growth portfolio, it's in the value portfolio and vice versa. And this creates an immediate problem. And that is that this portfolio of 50-50 has stocks that are very expensive in terms of price earnings ratio, but low growth. And why would an investor want a stock that is low growth and very expensive in their portfolio? It makes no sense. And that's one of the key insights of our paper, to get rid of those stocks. I'm willing to pay for high growth, but I'm not willing to pay for low growth.
So which mega cap names to you look expensive today without the fundamentals to justify it?
Yeah, so I'm not going to name individual names on purpose. I knew you were going to ask this. But what my research does is it provides a framework. So the number one idea is that if we're going to be investing in growth, then we should look at the characteristics that define growth. So things like sales growth, things like R&D growth, and things like gross profitability growth. So look at the attributes. So what I don't want are a selection of stocks based upon the fact that the stock is expensive. That's just not enough. So look at the growth characteristics. And then the second key part of our strategy, our research, is the way that you weight the stocks in a portfolio. And the standard way to do that is to weight the stocks by their market capitalization. And we argue that that is a mistake. And this is a mistake that happens all the time, especially for passive investors or index investors. When you weight by market capitalization, you don't care about fundamentals. All you care about is the price. And by construction, if a stock is overvalued, you will overweight it. If the stock is undervalued, you will underweight it. So instead, what we do is weight the stocks by the growth fundamentals. So there are two key distinctions in terms of what we do.
That argument is not lost on a lot of people. I've heard it before, not necessarily as eloquent as you put it. Do you think anytime soon in your lifetime we would see a fundamental change in the way some of our benchmark indexes are constructed?
We have to. Given the growth of passive investing, it's over half of all investing. And I've actually extrapolated it out. In less than 10 years, it could be 80%. So think of that type of investment. There's no what we call price discovery. So it doesn't matter what the fundamentals look like at a company. The passive investor just buys by market capitalization. And also what it does is, given that when new flows come in, there's a buy order that's put out for essentially everything. And what that does is it increases the correlation amongst the different securities. And when that happens, you decrease diversification. So at some point, there'll be so much passive investing that markets will become dysfunctional. And in my opinion, we will swing the pendulum the other way and move back to more active investing. So just to be clear, the active investor is looking at the fundamentals and deciding how much to allocate to that particular security. The passive investor doesn't care about the fundamentals. They just care about the price. And that's the key thing. So the market capitalization divided by the capitalization of the market is the weight for that security. Doesn't matter what the fundamentals are. And I think that is problematic. It's not the way I teach my students to do investment.
All right. Well, Cam, you've been teaching them well for quite some time. Really appreciate it. Professor Cam Harvey there, Director at Research for Research Affiliates. And you should actually go to their website and check out that paper that he co-authored back in March. A really interesting look here at how to think about the market. When we come back, we're going to turn to some of the individual movers into the close, including Walmart having its worst day since 2023. It's our stock of the hour, and it's up next right here on Bloomberg.
Time now for a stock of the hour. Shares of Walmart sliding in today's session after the big box retailer's forecast for second quarter adjusted EPS fell short of estimates. Bloomberg TV markets correspondent Nora Melinda joins us now. Nora, so talk to us about this miss. Is this a Walmart specific issue, or is this broader retail pressures that we're seeing?
So we're certainly seeing broad retail pressures across the board. In this particular print, it's a bit mixed because on the positive side, you did see that they saw comparable sales that beat consensus estimates. The street was essentially looking for an increase of 4.1%. But you're also seeing analysts over at RBC, UBS are also pointing to the fact that the buy side was looking for comparable sales rising 4.5%. So even though this seems to be good news in that they had this comparable sales beat, buy side still isn't really happy with this. Also on the downward side, you have that second quarter forecast that fell short of estimates, adjusted EPS also missing. And all of this, of course, in the context of the broader inflation, the war prolonging and really pushing up fuel prices more broadly.
Oh, well, I am curious, though, too. I mean, we've heard some relatively cautious statements from executives at other retail and consumer-facing companies, basically talking about gas prices, inflation, and whether that affects business going forward. But we did not necessarily see the same severe reaction in their shares.
Yeah.
Why are we seeing, this is a huge drop for Walmart. We haven't seen a drop like this in something like 2.5 years.
Well, if you think about Walmart, it's also just a broader indication of the economy as a whole. We know that this is one of the biggest companies in the United States, especially especially if you think about employees that are working there.
Yeah.
So as you look at the reaction today, we do see Costco lower. We're seeing other peers also falling off of this news, Kroger. And of course, people are also thinking underlying about whether or not a lot of these companies can be competitive when it comes to pricing. Walmart talked about the fact that they had to absorb almost a 20% increase that they've seen from fuel prices in this latest quarter, and they're expecting that to either hold or increase as we go forward. So essentially, it's just creating a bit of angst and scariness for a lot of people as they think about the broader sector and whether or not this could also hit some of those other consumer names to come.
All right, Nora Melinda there with a closer look at Walmart. Those shares having their worst day since November of 2023. As we move closer to the closing bells, we're going to get some broader insight out of Matt Rowe over at the Man Group. That's coming up next here on The Close, right here on Bloomberg.
S1 for, SpaceX was one of the more interesting documents that I've read for a company in my lifetime. So I think it's a very aspirational company. And on the other side of the coin, you have Nvidia, which is really just in the sweet spot of just profiting off the massive investment coming from all over into building, AI systems and data centers. So it's a really unique time in technology history.
Nvidia might be in the sweet spot, but the share has been on the back foot all day long. We heard from Ross Gerber at the start of the show about 50 minutes ago. Kicking us off to the close, I'm Romain Bostic. And Isabel, this is a market now that is really going to have to parse not only sort of what the next step is in this AI build out, but more importantly, where they want to allocate their money.
I feel like I'm a headless chicken because I just don't know where to focus. There's SpaceX, there's Nvidia, and we just got headlines. We started the show with the S&P in the red, and now look, it's higher by nearly 0.2%. And I'm reading our news article, and it's again on hopes that a diplomatic deal will come out of this war, and that it may be the end to everything. I mean, you're looking at yields there, still moving muted. I mean, last week was really just the wild moves that we're seeing, so now it's a little bit more calm and. Yeah, it's an interesting cross-asset move, Romain. I feel like we just can't take a breather.
Yeah, a lot does sort of for these markets to parse as they try to figure out what the next direction is. For a market, we should point out, pretty much across the board, not far off of their most recent record highs. Matt Rowe joins us here in Studio 2 to count us down to the closing bell. Managing Director of Solutions at Man Group. Matt, great to see you here.
Thanks for having me.
And I think Isabel kind of puts her finger on it. There is a lot for investors to think about, and it's hard to kind of focus yourself. I think Nvidia was supposed to be kind of the hub for everything when it regards to the tech trade, and which has basically been the main trade in equity markets. We heard from them last night. I mean, nothing to quibble about with the numbers, and the sell-off today is probably a little bit of profit-taking more than anything here. But what is Nvidia's future, not just as a stock, but as sort of the hub of this AI ecosystem? Because for the last 3 years, it kind of had this market to itself, and we know that's not true anymore. There's competition in chips, and of course, the whole AI flywheel has just gotten a lot wider.
It has, and I have sort of referred to this as their Peter Pan moment, meaning that they may not want to admit that they're growing up into a mature company that doesn't have exactly the same multiplicative growth potential that they once did, but they are behaving that way, right? They're taking the dividend to 25 cents from a penny, $80 billion share buyback. These are a lot of things that companies do when they don't have immediately obvious NPV positive projects to use their money, and they're broadening their investor base. They're catering to a broader range, so they're behaving like a more mature company. And I often refer to factor investing as being similar to fantasy football, right? Players have certain characteristics when they're young. As they get a little bit older, they're not quite as fast. Maybe they're a little more well-educated in the game, but they change over time, and so too do factors. So I think Nvidia is a name that investors can't ignore, but it's also a name that people have sort of muted expectations from going forward, and it's traded these days like an event name. So by that, what I mean is that people will go into the earnings, they'll establish a long position because not having it is a problem. But then once the earnings event comes and goes, maybe they shed a little bit of risk, make some room on the balance sheet for SpaceX IPO, other things that are coming down the pipe.
Well, let's talk about that. Speaking of, they have to have it. I mean, this is kind of, for better or for worse, this is going to be a must-own stock if you're a money manager. And there's only going to be so much to go around. It's going to be a small float, which probably means we're going to get a lot of activity and volatility when this hits the secondary market. Is the market ready for that?
I think it is.
Yeah.
I think what we're going to see is a very quickly developing option market structure. It already exists in sort of the OTC or the over-the-counter space. But you're right. Like, people can't be underexposed to this name, and it follows a theme. The same is true for Nvidia and other high-vol, growthy names that are in the AI category. So, if you don't own it with your peer group, if the whole thing falls and everyone owns it, it's our problem. If you don't have exposure to it and the market rallies, that's your problem, and that's a uniquely, you get a spotlight shined on you in a bad way.
So what is it like being a money manager? Because active managers had a strong start to the year, but Bloomberg Intelligence had some data that 25% of actively managed equity ETFs are beating the S&P 500. That's just a quarter, and breadth is falling to levels not seen in years. Yeah,
and I think it's really challenging, too, because dispersion has been very, very high, meaning that names have been going up and down and separating, and you haven't had a whole lot of correlation, which would mean that there's co-movement or moving together. So theoretically speaking, a market with a high degree of dispersion is perfect for active managers, right? Like, you can buy the ones that are cheap, you can sell the ones that are expensive, and when you get the market moving, you should be proven right, and you should be able to make money on it. The reason why it has been such a narrow breadth move is because the market has been driven by a very small subset of names. So you really, again, you can't ignore these names in asset allocation, and some of the systematic strategies have just been dogmatically exposed to that specific subset. Some of the active managers have tried to bob and weave, monetize in different ways, and anytime you try to monetize and reduce your risk into a rally, it's just moved higher. So, and the vol market this year, for someone like me, I find one of the most interesting things is that up vol, when the market's moving up, the realized volatility has been higher than when the market's been moving down. Very unusual from a market characteristic standpoint.
Zooming out a little bit, which concerns you more right now? Is it slowing growth or sticky inflation? And what do you think will happen if we have both?
Yeah, the PCE number coming out next week is going to be a big focal point. Warsh is focused on Dallas trimmed PCE, which is numerically closer to the stated target of 2%. The core PCE, I think, is what the market is more broadly going to be focused on. And I think it'll probably come in, my own opinion, is 3.3% or higher. Inflation has been persistent. We feel it. We see it. Companies like Walmart are starting to show that the consumer is sensitive. Their guidance is looking like there's not a ton of optimism there, at least cautious, let's say. So I think it's kind of all together, right? Oil prices are still priced in a macro shock way. Interest rates, 10-year through 30-year, are as high as they've been going back to 2009. That puts pressure on the way companies fund themselves. All else equal, takes prices higher. So I think it's kind of a perfect storm for an assault on consumers, really.
Well, does that mean that, at least as far as investing in consumer-facing stocks, is that kind of a no-go right now, or you don't?
I think, the Fed Reserve study from a couple weeks ago said that pretty much all of the tariff expenses and the energy expenses, Walmart said they're absorbing 20% of the 20%. Energy expenses. So some companies are taking it and absorbing it in margins, but it's passing through in a large degree. Yeah. I don't think that they're uninvestable, but I think it makes me a little nervous to see the more bottom end of the retail market start to guide a little softer, because 2/3 of GDP is consumer spending. But we do have this dynamic in the U.S. market now where 50% of consumer spending comes from the top 10% of wealth. Yeah. So they're not as sensitive to changes. It's a fuzzy picture.
Yeah, definitely a fuzzy picture. We're going to get a couple other retailers after the bell tonight. Matt, always great. Matt Rowe over at the Man Group, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Isabel Lee. Katie Greifeld is out on the week. Welcome to all of our audiences across all of our Bloomberg platforms, our global simulcast, counting you down to the closing bells. Tim Stenovic joins us from the radio booth. Emily Grafeo in today for Carol Masser. And Tim, a lot to parse here today. A very volatile day with the market starting it deep into the red. It looks like they could potentially finish it in the green.
Yeah, but searching for direction for much of the day, not knowing what to do, moving between gains and losses just about 6 or 7 times today. It does show, though, that the the market and the trade is still so tied to what we hear when it comes to the war in Iran, whether or not there will be a toll, what the supreme leader says or Iran's president says about uranium, or about not backing down. That moves the market still.
And of course, the big focus yesterday wasn't just Nvidia, but it was all of the companies going public that are still private. So we haven't seen moves from, of course, SpaceX and OpenAI, but interesting to watch Nvidia trading lower today despite that beat.
I just can't get over SpaceX. I mean, the company generated $18.6 billion in revenue, lost roughly $4.9 billion, yet investors want to assign a $1.75 trillion valuation. So you have to understand what that means. You're not betting on the company, you're betting on the future.
No, or what about betting on Elon Musk? Isn't that the Elon Musk premium?
Yeah, I don't think they're betting on the future. They're betting on Elon Musk. I mean, look, we saw this playbook before with Tesla to a certain extent, where there were these lofty goals, and at the end of the day, you either had to put your faith in Elon Musk and what he can deliver, or not. And it's binary, I think, for a lot of folks. And there are a lot of folks who, for whatever reason, are clearly on that train. And I think you're going to see that when this stock comes out into the public market with a small float and the frenzy that's going to be in the secondary market to get a piece of it. We get the closing bells here in New York, a much different picture than where we were just a few hours ago. All of the major indices are going to finish the day in the green. The Dow Jones Industrial Average up about 277 points, or 0.6%. The S&P up 13 points, or about 0.2%. The Nasdaq Composite up about 0.1% on the day. The 100 up about 0.2. The Russell 2000, that's going to be your outperformer on the day, closing higher by 26 points, or about 0.9%.
In the S&P 500, not quite an even split between gainers and decliners, Isabel. 286 stocks did move higher today, and the S&P 212 moved lower.
It is kind of looking split when we look at the IMAP. The big gainers are healthcare up by 0.6%, consumer discretionary higher by 0.7%, and infotech higher by 0.3%. You see this tiny slice of red there.
Well, let's focus on the green, at least right now, and talk about some of the big gainers for the day. I want to start with shares of IBM.
Wow.
They surged higher.
This is crazy, right?
This is crazy, right? 12% to the upside. This after the Trump administration agreed to award $1 billion to the company. It's going to build a foundry for producing quantum computing chips. IBM will also invest $1 billion into a new company called Andron. It'll produce the processors. The government awarded funding to more than a half dozen other companies as part of this broader $2 billion support package from the Commerce Department for quantum computing. Once again, shares higher today by 12.4%.
I do want to just interrupt. We are getting some earnings out of Ross Stores. This is the discount retailer basically reporting EPS that did rise on a year-over-year basis, $2.02 a share versus what they had the previous year at $1.47. Not sure what the comparison is with regards to analyst estimates, but when it comes to sales growth or sales overall for the most recent quarter, they did report about $6 billion in sales. Right on the nose. The estimate was for 5.6, and here's your guidance here. The company says it sees full-year EPS of $1.85 to $1.93. And I'm going to hold off on the comparison here because it looks like the previous comparison was much higher than that, which I think might actually be wrong. But you're seeing the initial reaction right here. And okay, there is a correction. So the EPS for the most recent fiscal year, for the fiscal year we're in right now, the company is saying expect $7.50 to $7.74. Its previous guidance was for $7.02 to $7.36. So forgive my pause there. The headline threw me off there here. So it does look like they are guiding above their previous estimates, Tim, and you see that reflected in the shares in the after-hour trade.
Yeah, look at that. Ross Stores up by more than 5.8% right now. One stock that is sort of searching for direction, but now moving significantly higher, is Workday. Shares in the after hours up by 5.3%. The company's first quarter revenue did beat estimates. First quarter adjusted earnings per share coming in above estimates at $2.66 per share. The company does see second quarter subscription revenue coming in above estimates at $2.46 billion. The company still sees fiscal year subscription revenue at $9.93 to $9.95 billion. First quarter revenue did beat estimates at $2.54 billion. And once again, see second quarter subscription revenue at $2.46 billion. This is a company, though, that has gotten beat up over the last few months. It's down more than 60% from those highs back in 2024.
You see Ross Stores gain 5% in post-market trade on strong comp sales forecast, so investors are kind of liking that. We'll wait for the earnings call shortly, but for now, it's looking like they're happy with that.
Yeah, and a bright spot here for Workday, Tim, as you mentioned, the stock getting absolutely crushed over the last year. It's kind of one of those quintessential software companies that now has to prove that it's not going to be disrupted by artificial intelligence. And at least in the latest earnings, the shareholders are happy with the company's plans.
All right, so we've heard from Ross and Workday. We're still waiting on Zoom, Deckers, and Take-Two Interactive, in addition to some others. Let's get back to some stocks, though, that moved in the actual cash session today. I want to go to Ralph Lauren. Shares of Ralph Lauren surged today. This after the company reported revenue and profit that beat analyst estimates. It finished higher by 14% today. Sales growth was led by Asia, particularly in China. Sales increased 31% on a reported basis. The company's core customer is resilient and able to withstand tariffs and economic uncertainty. Once again, shares of Ralph Lauren up by 13.8%. We'll go ahead and round that up. And more retail. This time, footwear, as we do wait for Deckers. Look at this.
Yeah.
Birkenstock.
Yeah.
I know this is your favorite, Romaine.
It is.
The Arizona sandal.
Yeah.
You have a whole closet full of them. I know you wear them with socks. It's weird with a bow tie.
The other day, I was, we had to go to a graduation.
Yeah.
And my teenage son, of course, he only brought sweatpants for some reason.
He wasn't the one graduating, was he?
So my wife took him to the mall to get something. He came back with Birkenstocks. Oh.
Yes. Okay, so that's the ultimate signal that maybe they are cool.
Yeah.
And they're good for your feet.
And they're good for your feet. Shares up today.
Only pack sweatpants together.
By more than 19%, the most going back to April of 2025. The company entered a $250 million accelerated share repurchase agreement with Goldman Sachs. Romaine, I know we got some other earnings crossing.
Yeah, let's take a look at Take-Two. Of course, kind of the backbone of a lot of the internet and the video that you watch here. The company saying that in its most recent quarter, it did see net bookings of about $1.58 billion. The street was looking for about $1.57. So we'll call that a match, if you will, for what the street was looking for. But the shares are moving lower here, and it does appear to have to do with the forecast. The company says net bookings for the current quarter that we're in, 1.32 to 1.37 billion. That's well below street estimates. The street was looking for 1.57. The company also says adjusted EPS in the current quarter will be 25 cents to 35 cents, which also looks like it might be a touch light as well. The company also providing guidance for the full year, but it's a similar story. Net bookings for the full year, 8 billion to 8.2 billion. The street was looking for 9.1. So very below estimates here on some of these key numbers.
Well, Zoom shares shooting higher in the after hours, up by more than 3% right now. The company boosted its fiscal year revenue forecast. It beat estimates. First quarter adjusted earnings per share also came in above estimates at $1.55. The company sees second quarter revenue $1.27 billion to $1.27 billion. That's just smack in line with estimates. Fiscal year revenue, the outlook, that's looking at fiscal year adjusted earnings per share of $5.96 to $6. That's what has investors excited. It saw $5.77 to $5.81. Once again, shares of Zoom Communications up right now by just about 3.9%.
Decker shares oscillating between gains and losses in the after hours trade. This is the company behind UGG and Hoka shoes. Their fourth quarter net sales did actually rise here and did actually beat estimates, up about 9.6% year over year to 1.12 billion. The street was looking for 1.08 billion. EPS coming in at 96 cents a share, which is slightly lower than what it was a year ago here. I have to look for the comp, but on an operating income basis, it does appear that they beat 156 million. The street was looking for 136 million here. We'll dive a little bit deeper into that there, but you can see the shares trying to get back into the green.
I'd be interested to hear what Zoom will say on the earnings call, because they're now really amping up their use of AI. And I feel like even in today's world, when we've been 6 years over the pandemic, people are still using Zoom a lot.
Yeah, and it's interesting to get a read here on the consumer when you look at Deckers Outdoor. As we continue to kind of understand the K-shaped economy, we saw Walmart really selling off, Ralph Lauren beating estimates here, and then Deckers Outdoor kind of right in the middle there and gaining. So a bright spot, at least for the consumer.
But did you know Ralph Lauren, I thought their conference call was interesting because they talked a lot. They said, look, basically, and I'm paraphrasing here, they basically said our customers are rich and they're going to continue to spend.
Right,
That's
exactly.
a paraphrase, so please don't anybody try to correct me.
Yeah. Right. The richer consumers are still doing well, and then the people
I think
who
resilient.
Are going,
resilient might be another word you could use.
Right.
Yeah, you can wear a Ralph Lauren top and Birkenstocks.
All right.
Why not, Romaine?
Well, there are a lot of reasons why not as well, but thank you for the sartorial recommendation.
All right, we're going to have to run. That is going to do it for our cross-platform coverage.
Emily, can you put Emily Graffeo on the screen, please, instead of Tim Stennis?
Yeah, that's...
We have to look at this nice jacket that she has. There you go.
Thank you.
Okay.
It's from a thrift store.
I'm told we have to go.
K-shaped economy.
I'm sorry.
I am the director now.
All right, now everybody's on.
Yeah.
This is the way we like it. That is going to do it for our cross-platform coverage of the market close. It's the closing bell. We're going to be back tomorrow, same time, same place, for a Friday edition of the closing bell.
When we come back, a deeper dive into the retail earnings we got out of Ross and Deckers right here on the close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. The S&P, the NASDAQ, and all the major indices here in the U.S. closing into the green. It was a relatively volatile day, and most of these indices spent much of the session in the red. Most of the action, though, at least on this particular day, was actually what happened overnight, and that was actually in Asia. South Korea's benchmark Kospi rallying 8% on the day, and that was largely because of the earnings that we got out of Nvidia last night. The idea that that AI tech story is actually broadening out from just the U.S. names to a lot of other names around the world. In fact, Nvidia actually closed lower on the day, the fourth straight time it's done that on the day after an earnings report. Meanwhile, you saw D-Wave, Quantum, Rigetti, and a lot of the quantum computer makers rally hard after the U.S. committed $2 billion to help build out quantum computing, about $1 billion of that going to IBM, which had one of its best days in year, rallying more than 12%. Meanwhile, Ralph Lauren, a phenomenal day, up 14% on the back of earnings that seem to suggest the luxury consumer is doing just fine. But Walmart, having its worst day since at least 2023, it raising a lot of concerns here about the health of its consumer, both high and low, and whether they can withstand some of the macro and inflationary issues. And that does bring us to our top story of the hour, the state, a very mixed state of consumer spending. This spate of earnings from retailers this week, which also included Target and Home Depot, Lowe's, TJX, it painted a relatively cohesive picture of the consumer, I think. Store traffic is up. Receipts are larger, but shoppers are discerning on price, and they are relying more on credit cards rather than cash. In fact, with a couple of exceptions out there, most of the executives have expressed caution about the rest of the year amid the elevated gas prices, the elevated grocery prices, the elevated interest rates, and, well, elevated everything that maybe could soon cause shoppers to pull back. Well, I don't know. We just got earnings out of Deckers, which I would consider to be relatively discretionary, a beat and a raised quarter. You see investors pushing those shares higher by about 5%. And we also heard from discount multi-brand retailer Ross Stores, which also beat expectations and raised, and you see those shares rallying higher as well. Deborah Weinswig covers the retail space as the founder and CEO over at Coresight Research. And Deborah, maybe you could kind of make sense here. I mean, is the consumer healthy? I mean, what's actually driving some of these beats that we've seen for some of these companies?
I mean, Romain, that's the question of the hour, the day, the week. We've seen, you talked about Walmart, but I do think that across the board, earnings have been better than expected. Gross margin, SG&A has been pretty disciplined, which has led to many earnings beats. And guidance, for the most part, has been pretty positive in the back half of the year. I do think there's an air of caution just because we don't know what's going to happen with tariffs. And so I think that is also part of the conversation. Mm-hmm. And the other kind of wild, if you will, dice is on gas costs. So I think the gas plus the tariffs, that's, I think, leading to retailers who want to maybe guide a little bit more cautiously, but yet they're seeing what's happening, which is stronger than that.
Well, that's what I'm curious about. I mean, some of the guidance that has been given has been relatively cautious. There have been a few guidance that I've seen that have been a little bit more aggressive here. How much stock can you even put into those, given this overhang that we still have with the situation in the Middle East and the upward pressure that's been putting on the consumer?
I think the challenge with gas prices is that it's something that you see almost every day. And so that is why that typically translates into more cautious consumerism. And so, you would think about, like the bottom of the hourglass, right? Leaning more into the discounters, more into kind of off-price retail, thinking more about the dollar stores. And we've definitely seen that. But, in the middle where we've seen a lot of retailers, let's just say, move one way or another or just completely out, that's where I think you're seeing some of the challenges. And then obviously luxury is continuing to be incredibly strong. I think even stronger than many of the luxury retailers had thought. So I do think that there is this air of concern. But, when you think about Deckers or Ross Stores, which I think Ross just blew all of our minds, those numbers, right? As an analyst, you take a step back and you're like, what am I missing?
Well, yeah, and I mean, I'm just looking at the release here. I mean, we should just point out the CEO, Jim Conroy, he's talking about this guidance here, saying, look, we're off to a strong start. Everything's executing. All these efforts that they've made to kind of turn things around are going well here. And I don't really see, and again, this is just a statement. We have to wait for the conference call, but I don't really see any qualifiers here about economic conditions or the macro.
None. And I think that you brought the point around store traffic is.
Yes.
And this is what's so interesting. So I was just at ICSC on Sunday, Monday, Tuesday. I'm at the lead now. Is that I think everyone's pinching themselves because physical store traffic is at record highs. And it doesn't matter if you're strip, power, enclosed mall, open air center. It is strong across the board. And I think it goes back to, right, maybe the reasons that people are shopping, right, there's need, there's want, but also maybe it's community and it's meaning something more than it has in the past. Because a lot of these numbers are beyond what anyone expected, especially at this point in the cycle. So I think there's something else here that's translating into these higher sales and traffic.
I am curious, and I've heard this anecdotally from several folks, both in terms of on the retail side, but also in terms of the suppliers, and as well as like the real estate and mall owners. Maybe there's something in the water right now. And I do wonder that as an analyst, as an investor, is there a way that you can sort of bottle that and quantify it as a way to sort of figure out what the next step might be in terms of where the stocks go and where their fundamentals go?
Well, that's the really interesting piece, is just coming off of ICSC and talking to mall owners who are all trying to buy more malls and can't because they could, but they are paying a price that's way beyond where they've capped it. There is such huge demand because it goes back to, especially if you have food and beverage, right? People are spending more dwell time or spending more time in restaurants, right? That's more of their entertainment. They're spending more there than they have in the past. So you start to think about, right, they're spending more in restaurants, they're spending more in retail, but there's got to be this kind of other side of it. And I think what's really interesting in retail right now and restaurants as well and real estate is that there's all these other alternative revenue streams, right? Walmart talked about how strong, right, their ad media was, retail media, right? There's also data, there's also retail as a service. So, Romain, you and I talked a little bit before the call. I think the consumer also has other revenue streams, right? Some of these side hustles, right? Selling, your previously loved goods, right? Maybe you have a little bit of a gig job. Those kinds of things, which aren't necessarily showing up in a lot of the payrolls. So I think there's more. I think this story is the most complex it's ever been. And I think everyone was ready for a fairly, not only negative quarter, but negative guidance. And we haven't seen much of that.
Absolutely here. Deborah, great stuff as always. Deborah Weinswig, founder and CEO over at Coresight Research, both Deckers and Ross Stores higher here in the after hours trade. When we come back, we're going to talk about the freight broker RXO. It's up for a fifth straight day here. We're going to catch up with the CEO, Drew Wilkerson, who's actually going to give us some insights as to why his business is starting to improve. That's coming up next here on Bloomberg. Freight broker RXO rallying more than 30% since Monday. The spike follows the firm raising its outlook for truckload gross profit per load for the month of May, saying the metric will outperform typical seasonal patterns. The CEO of RXO joins us right now, Drew Wilkerson. And Drew, I want to go back to your earnings day earlier this month, where you had kind of talked about the potential for expected truckload gross profit per load to actually decline in May. Now you're saying that you're expecting that to outperform, to at least basically be about flat. And some of this has to do, my understanding, with sort of more capacity being taken out of this market after this recent round of annual inspections.
Yeah, Romain, there's three things that I would highlight. First, you've seen a lot of capacity come out of the market that was driven by non-domiciled and English language proficiency regulations that have been put out. And off of that, you saw tender rejections go from mid-single digits to now they're in the mid-teens. So what happens when routing guides start to break down is customers go back to doing business with who they trust the most. And that's where RXO has proved to deliver time and time again. We've got a history of results with our top customers. And then the second thing that I would highlight is, if you look just recently, the Supreme Court ruling in the freight brokerage industry is something that everybody was watching closely. And now customers are vetting carriers closer than what they ever have. And we've got the best track record of how we have a process of who we're doing business with on the carrier side. We haul lots of high-value cargo goods, and for us, you've got to have great processes of vetting the carriers that you're working with off of that. So I think customers go to who they trust, and we're set up in a good position off of that.
I am curious, though, about the Supreme Court ruling, and we saw a pretty visceral negative reaction in RXO, CH, and a lot of the other peers of yours. And I think, if I'm correct, I think your shares have more than recouped those losses. But since then, why do you think investors were so concerned about the potential liability for brokers like yourself for anyone who gets hurt?
Well, I think the ruling came out before anybody expected, and it was the fear of the unknown. But as people have gone in and they've done the work, they've looked at who wins. Large-scale brokers who customers have a history with, who have a process of how they vet carriers, of knowing who they're doing business with, making sure that the carriers are compliant from an FMCSA perspective, making sure that their insurance ratings are up to standard. All of those things are things that we've been doing for decades, and we continue to look for ways to have a continuous improvement mindset on how we work with the carriers is very important, and we understand that the carriers are out there as a representation of the shippers, and that's the last visibility that end consumer has sometimes is who they're doing business with. So being able to make sure that there's confidence on who's the other end of that is extremely important, and we take the protection to make sure that our customers are protected during that.
But just to be clear, and this is more a question for the investors watching, your insurance costs, are they going to go up? And if they do, is it going to be material in any way to your bottom line?
I don't think it'll be material to the bottom line over the long term. We don't know yet. Obviously, we're locked in for this year of what insurance rates are going to be. I would expect them to go up some, but also I would think that when you look at it, there's 20,000 brokers out there. And so you start to look at the tail of the brokerage industry, and I think you're going to see that large players are going to be where shippers start to consolidate and do business with. And off of that, we should be able to take market share in a meaningful way from the market overall.
I do want to ask you just about kind of the broader macro picture, which obviously you have a lens into, given what you do. If truck rates are up and and I know that's beneficial to you in a certain way, everyone out there is concerned right now about inflation and whether that ends up being some sort of impediment to a continuation of consumer spending and to a certain extent for business spending. Are we anywhere near that level of concern yet?
Yeah, I think, well, you're right. Truck rates are up, but they've been down for 3.5 years. And so you're seeing the first signs of life in the trucking industry. And I think this is the very early innings of where rates are starting to go over time. When you look at the price that it costs a carrier to run, we've been well below that for a couple of years. So this is just more right-sizing what's going on in the market in the transportation space.
And finally, I'd be remiss. I mean, our entire show today, and really the last couple of days, has been so focused on Nvidia and SpaceX, basically AI. And I know that technology has been a big component of what RXO does. What changes, if anything, for you with regards to the investments that you're going to continue to need to make with regards to your technology?
We're going to continue to increase productivity. Our productivity was up by 15% on a year-over-year basis last quarter. We're going to continue to expand margins versus what's going on in the market. And we're going to outperform what happens in the marketplace of taking market share. If you look at the month of April, our volumes were down 2%. The market was down 4%. So we're outperforming what's happening in the market in April, and I expect us to continue to do that. We pointed to the middle of the year as for us to be able to get on a path to be able to outperform in the market in a big way. And right now, the team is set up very well to do that. We've got a strong pipeline. We've got great relationships with our customers, and we've got the carrier capacity to be able to service them at scale.
All right, Drew, got to leave it there. Drew Wilkerson is the CEO of RXO, a stock that is actually up about 100% just since mid-March off this year-to-date lows there, and now on a 5-day run, the longest daily win streak we've seen for that stock going back to early of last year. Now, when we come back, we are going to talk about AI. I had a chance to catch up with two pioneers in the AI space, Yann Lecun and JP Vert. They're talking about the next phase of AI, and it's not LLMs. You don't want to miss that conversation. That's coming up next here on The Close, right here on Bloomberg. One of the more interesting nuggets in Nvidia's earnings report yesterday was the idea that edge computing is going to be a much bigger business for Nvidia and, quite frankly, for everyone else. It's this idea that the traditional LLM model in the data centers, that runway, it might be over. Yann Lecun, he's a pioneer in this space, and he's been talking about the need for world models, something completely different than what we've ever talked about. He used to be the chief AI scientist over at Meta. He now is co-founded Advanced Machine Intelligence, one of the big architects here of modern deep learning, and he's working with a guy named Jean-Philippe Vert, who is the CEO of Bioptimus, and both are right now at the intersection of what the next phase of AI will be. Here's what they had to say.
You very clearly see a trend. Certainly in research, because the trends in research precede the trends in industry. Industry kind of trails behind a little bit. In research, you see a lot of people starting to get interested in what we call world models and physical AI, and sort of dealing with real data as opposed to language or sequences of discrete symbols. I've been working on this for a very long time. The better part of the last 15 years, essentially, and making fast progress over the last 5, which sort of prompted the creation of Amilabs, the company I started recently. So you see that trend. I think 2026 is going to be the year of the world model, and you're going to see this type of model emerging more and more.
Are you starting to see more investment in that space, Yann? Because we know that so much of the CapEx spend, certainly in the U.S., has gone more towards the traditional LLM data center model. I know things are maybe a little bit different in Europe and in Asia, but are you seeing more interest with regards to the money investors are willing to put towards your vision of AI?
Oh, yeah, absolutely. And the reason is simple to understand. There is a lot of expectations that robotics is going to be a revolution, essentially, in a big market, eventually. But the secret of the industry is that none of the companies at the moment that are building robots, like humanoid robots, none of those companies has any idea how to make those robots smart enough to be useful. Domestic robots or robots in industry that will have some degree of generality and adaptability. And so there's a big push for AI to make progress towards being able to deal with physical tasks, first of all, understanding the physical world. And so that's what is prompting this investment. There's nothing wrong with investing in LLM. LLMs are useful. Mm-hmm. They're just addressing a completely different set of applications, really.
Well, when we talk about a different, completely set of applications, I am curious about the work that you've been doing, JP, in the world of biology and the idea of what type of, forgive me if I get the phrase wrong, but what type of language models do we need where we can have better drug discovery and better research when it comes to developing and just simply finding out what's out there when it comes to biological advancements?
Yes, absolutely. I think biology is exactly one of the fields that is going to be disrupted by AI. But, LLMs won't cure cancer. Cancer doesn't speak English. Just like when you think of robots having to interact with the 3D world, when you're looking for a drug on cancer, the world is not the room. It's the cells, it's the molecules, it's the tissues. So what we need here is an AI that understands not English, but that understands how biology works. And that's exactly what we're building at Bioptimus. As you can imagine, the architectures, the way to train the model is pretty different from LLMs, but the high-level idea is the same. If you have enough data and enough computing power, then you can train systems that, from the data, learn how the world of biology works. And that's what we need to move from trial and errors in medicine and drug discovery to more rational design.
Well, but as we're sort of trying to build the technology that kind of learns from physicality, biology, et cetera, JP, I am curious about sort of what actually is required, what more is required, whether it comes to the sensors, when it comes to the data, the compute, and really just the overall architecture of what you are trying to build.
So there are many pieces in the puzzle. I think something quite specific in biology and in the models we build is a notion of multimodality and multi-scale. So to be concrete, when you want to understand cancer or develop a drug, you need to be able to relate what happens at the level of molecules. The drug is a small molecule, but the impact is at the level of a full body, full organism. So part of the complexity of it is being able to collect the data and to build models that connect the different scales of biology, from molecules to a metabolic pathway, to a cell, to a complex tissue. So I think this is something quite specific in biology, which in turn means that we need to develop new AI models, with dedicated ways to train them. It's a bit different. So there are similar concepts to LLM and world model, but they have to be specified to be able to learn from the data we have, again, which go at different scales. I think that's the main complexity.
So, Yann, is that something that has to be done from scratch, or can you kind of take some of the existing LLM paradigm, the LLM models out there, and build on that to that vision?
No, it's really a different architecture. So, of course, all of this uses neural networks and deep learning, and the techniques that have been developed over the last few decades to train those systems are the same, but the architecture must be different, because the way an LLM works is that you train an LLM to predict the next word in a text, essentially, and because there is a finite number of words, it's relatively simple to. You cannot predict exactly which word will follow a particular sequence of words, but you can produce some sort of probability distribution over all possible words in a dictionary. But when you try to use the same kind of technique to train from, let's say, from video or from sensor data, from biological measurements and things like this, it doesn't really work, because there's an infinite number of plausible predictions that are all compatible with what you observe. If you ask a system to predict what's going to happen next in a video, there's basically an infinite number of plausible things that may happen. And so those generative AI architectures that are used and so successful with language really do not work for the real world. You have to come up with new architectures. The ones we use are called JEPA. That means joint embedding predictive architectures. And then for certain types of applications, you need different types. But really, it's a new set of techniques.
I am curious, though, too, and this is a question for you, Yann, but it applies to both of you, because both of you at one point were basically under the umbrella of some of the large companies at the forefront of it, whether we're talking about Google and Alphabet or over at Meta. Why did you feel the need that in order to see out your vision, you basically needed to do it more as a startup rather than through what was already an existing, let's face it, multi-trillion-dollar apparatus in those two companies that I just named? Yann?
A number of reasons. So the first reason is that Meta, felt it was kind of falling behind a little bit the state of the art in LLM. So it chose to refocus most of its efforts on catching up with the rest of the industry. And there is this phenomenon in Silicon Valley where, basically everybody is working on the same thing. Everybody is trying to sort of, be in the race of LLM. It's kind of digging the same trench. What I was working on and still working on is different. And to some extent, LLMs were kind of sucking the oxygen out of the room. So that's one factor. The second factor is that the results we were starting to get were really promising. And so it was time to make the transition from, academic-like research, if you want, to sort of go into high gear and make those things real. The third factor was that most of the applications of this sort of new, physical AI, if you want to call it, is in industry, and these are domains that Meta was not particularly interested in, controlling industrial processes or robotics or health, for that matter. And then the third factor was that there was visibly a lot of interest from investors to really make a bet on this next revolution.
Well, they've certainly made a bet on you, Yann. They're making a bet on you too, JP. And I am curious about the geography of this as well. I sit in the U.S., and of course, let's face it, us Americans, we have a certain worldview of ourselves. And there's been sort of this knock amongst U.S. investors that Europe wasn't innovating, that Europe was not the place to go if you were looking to invest in AI. Both of you are headquartered in Paris. And I am curious if that is sort of a misconception. Is there a startup culture and a technology culture that is advancing in the AI space in a way that can be commensurate, at least in terms of scale, with the United States?
Yeah, I really think so. I mean, probably it started a bit later than in the US, but when you think of Paris, I think one of the main ingredients is the talents, right? Well-educated people, especially in CS, computer science, in applied mathematics. We have all of that in France, in Paris in particular. If you look at the ecosystem now, you have all the frontier AI labs, including the large players have research labs in Paris. And in the last few years, we've seen really many startups, very innovative startups emerging. I would say, having myself lived, in California, for example, probably Silicon Valley is very good for velocity consumer product. But when you think of deep AI, deep tech, scientific grounded AI, requiring very deep expertise. In my case, we need AI, but we need knowledge in biology, in medicine, etc. I think Paris is an extraordinary place for that.
All right, and we just heard there from one of the godfathers of AI, Yann Lecun. He used to head Meta's main AI lab. He now runs his own company, Advanced Machine Intelligence. And Jean-Philippe there, who was actually one of the leads over at Google's AI project before spinning off there to found his own AI biology company, by Optimus. Of course, that was a big focus of the markets today, despite the back foot that we saw by Nvidia as investors start to reallocate capital. There was also a lot of activity going on in the world, of retail. We got two big retail earnings after the close today, and you're looking at the after-hour moves in them. To the upside for Ross Stores, a beat and raise in the most recent quarter. And a similar story for Deckers Outdoor, of course, the owner of Uggs and Hoka. Those shares up 4%. And Take-Two Interactive had a volatile few minutes there when those earnings just came out, but investors now starting to parse just what the future of the backbone of the internet is. And at least for right now, they seem to like what they see out of Take-Two. We'll be back in a moment. This is Bloomberg. All right, we've been talking about SpaceX all day, and for investors, we've talked about the challenge of just even trying to value a company like this. But there's another big issue, and that's corporate governance. For the city of New York, the city comptroller, Mark Levine, sounded the alarm on Musk's structure, warning that public shareholders would acquire the majority of the economic exposure without a corresponding proportional voice. Of course, a lot of this refers to what we now know after seeing that S1 is the idea that Musk is basically controlling the entire show over there. Joining us right now is Mark Levine. He is the comptroller for the city of New York. They're basically our CFO, if you will. You oversee, and the reason why this letter matters is you oversee the main pension plans here. So about $280+ billion of money that belongs to the residents of the state of New York, or the city of New York. And one way or another, to a certain degree, you're probably going to end up owning SpaceX shares.
Yes.
What is your main concern? And is there a way that you can avoid, I guess, whatever this potential corporate governance issue is?
Look, we own SpaceX now in the private markets, and once it goes public and enters the S&P, which it appears it will be expedited to do, through indexing, we're going to own a large amount of stock in the public company. And I'm okay with founders who want to exert control. I get that. But what Elon Musk is doing here is taking it to a whole new level. This level of control, dominating shareholder power, no independent board, occupying both the CEO and chairman's role at the same time, really eviscerating shareholder rights to sue and take other actions. And I represent shareholders. We have a $325 billion pension fund. We probably have $80 billion plus in indexing. So we're going to be a major shareholder in SpaceX. And I think that efficient capital markets require democratic governance and transparency, and it appears we're not going to get that out of SpaceX.
The letter that you sent, it also included the heads of a couple of other pension plans. And I do wonder, is there any sort of regulatory or legislative change that could be made to address, and this has been a growing problem for a while. We had a lot of the same concerns with Tesla, and it's not just Elon Musk. There have been other sort of tech companies out there where the founders have had outsized voting power and power over their boards in a way that basically meant that if you were a shareholder, certainly a passive shareholder, you basically had to take whatever they gave you.
Yeah, this is a trend in Silicon Valley. Of course, we'll see it with Meta, et cetera, and Google to some extent. But this is going way beyond what we've seen in those companies. And so, yes, I've joined with the state of New York comptroller and the head of the largest pension fund in California. We have $1 trillion in assets combined. And so we're making our voices heard. We are presumably all going to be major shareholders after the IPO, and we're going to continue to be active. As for regulatory help, it does not seem that that's coming certainly during the Trump administration. So I think it's on us as major shareholders to speak up for our employees and retirees, and also millions of shareholders around the company who also are going to have money in index funds, retirees in the private sector, and they deserve democratic corporate governance as well.
I do want to ask you just about kind of the overall trends right now that we're seeing right now with artificial intelligence. I mean, by almost every objective measure, this does seem to be like one of these big transformational moments in our economy, in our society. There's going to be good with that, but there's also going to be bad. And I do wonder as to, particularly in your role, how you find the balance.
Look, this is very much a New York story. I think more than people realize, our economy is tied up in New York City with the financing of AI, so we've gotten a huge upside from that. In the last few years, we are financing the data center boom, among other things. Also, this is the capital of white-collar work. We have 1 million people who come to office buildings every morning in Manhattan, careers that are very exposed to AI. So depending on where this goes, we could get an enormous economic boost, or we could pay a real price. And my office actually issued a report today where we looked at 5 scenarios ranging from very good to very bad. Whether we have an AI bubble burst, whether we have an actual supercharge in productivity that benefits the city more broadly, whether we lose jobs. We're not even having this discussion right now in local government. We're not doing anything to prepare, and we're headed into unknown territory.
What's the potential scenario? I mean, when we talk about white collar, and let's just take finance, because, I mean, there's been a lot of talk, particularly with a certain research jobs, certain types of investment banking jobs, the idea that you could maybe potentially replace some of those human beings with whatever the AI tools are. Maybe that's not right now today, but most people think that will be very close in the future.
I think we might already be seeing it, and we have some data in New York that is very interesting. For the first time ever, the unemployment rate among young people in their 20s in New York City is higher for those who have a college degree than those who do not. We've never seen that in the data, going back decades. That, to me, can only be explained by the fact that companies that have white-collar workers are slowing down, bringing on entry-level talent. This is an early sign of what could be accelerating. By the way, talk to any person in their 20s in New York City. Breaking into the job market is brutal right now, and I think this is partly what's driving that. I expect it to be accelerated. What are the most exposed sectors? It's finance, it's accounting, it's business services, it's media. Those are the pillars of New York City's economy. Right. So we here need to have a plan to deal with this. If we take a hit to our budget, if we have a lot of unemployed people, and the plan I put out today calls for us to start to build up a reserve fund so that we can handle that uncertainty when it hits.
With regards to that reserve fund, are we talking about something that would be temporary in nature, or are you talking kind of long-term, almost endowment-like, if you will, to sort of supplement what gets lost?
Yeah, it's almost like a sovereign wealth fund for New York City. We have a mechanism. We have a rainy day fund. It's very tiny. It's only about 2 or 3% of our total tax revenue. It's not going to be enough to get us through the kind of turbulence that I'm talking about.
Is the mayor on board with this?
I hope so. We're pushing hard. It's not easy because we need to get the money. I'm going to be fighting for this. Our budget's due in June. This is going to be a major theme for me between now and then and beyond.
Well, when we talk about sort of preparing New York City for what the future might be, how real do you think this threat is compared to the multitude of threats? I mean, it seems like every 2 years somebody says, you know, New York City is over. All the people in Wall Street are moving to Florida. You had the COVID pandemic. You had this, that, and the other here. Why should I take this more seriously than all those other threats, which we now know, at least long term, did not sort of end up being the bust that we thought?
You're making a really good point to your viewers who are not in New York City, who think this is a hellhole right now. New York City's booming by almost any measure. Commercial real estate leasing is on a tear. The best it's been in 20 years. We had 65 million tourists here last year. You can barely walk in Times Square right now. Crime is dropping here in many, many ways. Demand for luxury housing, for all housing, is off the charts. Rents, off the charts. As of today, May 21st, 2026, we're doing well. We've overcome the naysayers again and again. But I think that AI needs to be seen as unprecedented. And yeah, we did great in the internet boom. New York City has thrived since the internet boom. But I don't know. We don't know. We could see another boom built on this. If we are the capital of AI, applied AI, we continue to finance this. But we have to be ready for the downside. We're not, and I put out my report today to sound the alarm.
Do you have confidence, if I brought you back a year from now, that we'll be prepared?
We are very far behind right now. This is not a major topic, even of discussion in local government. Maybe we're hoping on the federal government to save us, but I'm not optimistic about that. Cities need to start taking charge because cities are on the front lines of this because of the nature of office work. And I'm hoping we can lead the way in New York.
Mark, really appreciate it. Mark Levine, the Comptroller of New York City. This is Bloomberg. All right, we wrap up another busy day here on Wall Street. Investors are going to be looking ahead to what transpires over the next 24 hours, and it's going to be a bit of more of a refocus on the macro. That includes a read on consumer sentiment. At 10 a.m. Eastern Time, we are going to get the latest update from the University of Michigan as to just how consumers and households out there are feeling. It'll be an interesting backdrop, given some of the relatively positive earnings that we've seen out of some of the retailers this week. The bond market, we should point out, is actually going to close early tomorrow at 2 p.m. Eastern Time ahead of the Memorial Day holiday weekend, which of course is observed on Monday. We're going to get some Fed speak out of Fed Governor Christopher Waller and the APEC trade ministers. They're going to begin a two-day meeting in China, trying to advance cooperation throughout that region. We'll have full coverage of all those events if they do move the markets right here on The Close. Balance of Power, they're up next at the top of the hour on Bloomberg.